Stop everything you're doing right now. It's Saturday, January 18th, 2026, and while you were going about your weekend, while most of America was distracted by whatever trending topic dominated social media this week, something absolutely extraordinary happened in the silver market that 99% of people will not understand until it's far too late to position themselves. And what I'm about to reveal to you in the next several minutes is not speculation, it's not theory, it's not hype. It's documented evidence of the largest physical delivery event in modern silver market history, and it's telling us something that should fundamentally change how you think about what's coming. In the last few weeks, not months, not years, weeks, nearly 100 million ounces of physical silver have been stood for delivery on the major futures exchanges. Let me repeat that number so it sinks in. 100 million ounces. That's not paper trading. That's not contracts being rolled forward to the next month. That's not financial engineering or leverage games. That is actual physical metal being demanded, allocated, removed, and taken out of the system. And when metal gets pulled out of the paper market at that kind of speed, at that kind of scale, it's not just a large trade anymore. It's a message. It's a signal. It's someone or multiple someones telling you exactly what they think is coming, and they're putting billions of dollars behind that message. Now, before I break down exactly what this means, who could possibly be behind it, and why this represents a fundamental shift in how the silver market operates, I need you to understand something critical about how these markets actually work. Because most people, even people who own silver, even people who follow the market, don't understand the difference between the paper silver market and the physical silver market. And that difference is about to become the most important thing in precious metals. The paper silver market is enormous. It's the futures contracts traded on the COMEX, it's the options, it's the ETFs, it's the derivatives, it's the synthetic products. On any given day, billions of dollars worth of silver changes hands on computer screens. But here's the thing, almost none of that trading involves actual metal. It's claims on silver, it's promises, it's leverage. The entire system is designed around the assumption that most contracts will never result in physical delivery. They'll be closed out, rolled forward, cash settled, or offset. That's normal. That's how the engine runs smoothly. But every once in a while, and this is one of those moments, the big players stop playing the paper game. They show up and say, "No, I don't want your promise. I don't want your paper claim. I want the actual metal. I want it delivered. I want it in my vault. I want physical possession." And when that happens at scale, when 100 million ounces get demanded in a matter of weeks, the entire illusion of infinite liquidity starts to crack. It's like everyone using credit cards and suddenly half the customers walk into the bank and demand physical cash. The system isn't built for that. Let me give you the specific numbers because they're staggering. One recent major delivery month saw close to 70 million ounces stood for delivery. That alone would be remarkable. But here's where it gets truly unprecedented. In what's supposed to be a minor delivery month, the quiet months when the system is supposed to breathe, when activity is supposed to be minimal, we saw tens of millions more ounces demanded within days. Within a single week, 38 million ounces stood for delivery in a non-major month. Think about what that means. Minor months exist precisely because the market needs periodic relief. They're the months when speculators roll their positions forward, when the exchange can rebalance inventory, when the physical logistics can catch up. But instead of quiet, we're seeing the opposite. We're seeing aggressive, persistent demand for physical metal regardless of whether it's a delivery month or not. It's like someone is pulling oxygen out of a room, and instead of waiting for the scheduled time to open a window, they're kicking down the door. So here's the question that transforms this from interesting market data into something potentially explosive. Who is doing this? Because retail investors, even very motivated retail investors, even the most dedicated silver stackers, don't show up and demand delivery of 38 million ounces in a week. Let me put that in perspective. At current prices, 38 million ounces represents roughly $3.5 billion worth of silver. That's not a bunch of individuals buying tubes of coins. That's not even a large dealer restocking inventory. That's institutional scale. That's government scale. That's the kind of tonnage that requires military-grade logistics, specialized transport, secure warehousing, and strategic planning. The list of entities that can operate at this scale is very short. Major governments building strategic stockpiles, massive industrial companies securing supply chains, sovereign wealth funds, central banks, or consortiums of large institutional players acting in coordination. And when you ask why any of these players would want that much physical silver right now, why they'd tie up billions of dollars in a commodity, why they'd deal with the logistics of moving and storing hundreds of tons of metal, the answers get uncomfortable very quickly. Maybe it's a government that's decided silver is a critical strategic material and they need to build domestic reserves before supply tightens further. Maybe it's an industrial giant that depends on silver for manufacturing and they've seen the supply projections for the next 5 years and realized they need to act now before it's too late. Maybe it's a financial institution that understands the paper silver market is far more fragile than the public realizes and they're quietly positioning for a delivery squeeze that could send prices vertical. Or maybe, and this is the scenario that should keep you up at night, it's all of the above. Multiple large players, all reacting to the same set of signals, all moving simultaneously. Because here's what you need to understand about markets. Major moves rarely happen because one big player does something. They happen because multiple informed players all see the same writing on the wall, and they all try to get through the same door at the same time. That creates stampedes, that creates squeezes, that creates repricing events that shock everyone who wasn't paying attention. Now, while this delivery frenzy is happening, what is the mainstream financial media saying? They're talking about chart patterns, they're discussing technical analysis, they're debating whether silver is overbought or oversold. They're giving you the same recycled narratives about volatility and risk management, but they're conspicuously not talking about the one metric that actually matters. Who is removing the metal from the system? Because that question leads to uncomfortable follow-up questions. What happens if the exchange can't meet delivery demands at the pace buyers are demanding? What happens if we discover that the paper claims on silver vastly exceed the physical silver available for delivery? What happens when the illusion of infinite liquidity meets the reality of finite physical supply? Let me explain why this matters through a concept called rehypothecation. It's a fancy financial term for a simple problem. The same underlying asset gets promised to multiple parties. Think of it like a parking space that gets rented to 5 different people because the landlord assumes not everyone will show up at the same time. It works great until everyone shows up. In paper, precious metals markets, the same physical ounce can be represented by multiple layers of claims. You've got futures contracts, you've got ETF shares, you've got unallocated accounts, you've got options, you've got swaps, you've got synthetic derivatives. All of these instruments create the appearance of abundant silver. They create volume, they create liquidity, they create trading opportunities and fees for brokers and banks. And they create an entire ecosystem where people can speculate on silver prices without ever touching actual silver. But the weakness of this system is glaringly obvious. If too many people demand the actual physical metal at the same time, the paper promises get exposed as exactly what they are, promises that can't all be simultaneously fulfilled. This is why the best analogy for understanding what's happening isn't a normal market correction or a normal bull run. The best analogy is a redemption event, like a money market fund that promises daily liquidity but holds illiquid long-term bonds. It works fine while everyone stays calm. But when people rush to redeem, when they all want their money at once, you find out very quickly what's real and what's just accounting tricks. The silver market has this exact same structural vulnerability. It can manage infinite paper flows because paper is easy, but physical flows are a completely different animal. Physical requires actual metal to be located, allocated, transported, verified, and delivered. Physical has constraints, physical has limits. Physical is real. So why is this happening now? Why January 2026? Because this delivery behavior isn't occurring in a vacuum. It's happening alongside a series of policy shifts and supply chain developments that are fundamentally changing the landscape. Silver has been officially designated as a critical material by multiple governments, not because it's shiny, not because it's a collectible, but because it's essential. Essential for electronics, essential for solar panels, essential for electric vehicles, essential for 5G infrastructure, essential for military systems, essential for the entire industrial backbone of modern technological civilization. And once a material gets labeled critical, everything changes. It stops being viewed as just another commodity and starts being treated as a strategic input. That's a completely different mindset. That's the mindset where governments start thinking in terms of stockpiles, domestic production, supply security, and export controls. While the public debates whether silver is too volatile to own, the big institutional players and governments are asking a completely different question. Can we secure what we need before everyone else figures this out? Now, layer on top of this the reality that a massive share of global silver refining capacity is concentrated in just a few countries. When major refining nations start tightening export rules or prioritizing domestic needs, the global supply that analysts talk about becomes less global very quickly. And here's the part people don't like to admit because it sounds conspiratorial, but it's just rational behavior. When a country controls a huge portion of the world's silver refining, they don't need to impose an outright ban. They just need to slow down the faucet. A small policy tweak, maybe they require refined silver to be offered to domestic buyers first, maybe they add export licensing requirements, maybe they impose quotas, and suddenly the silver that exists somewhere in the world is very different from silver that's accessible to global markets. So when you see massive delivery demands on futures exchanges at the exact same time that policy signals are shifting toward resource nationalism and domestic prioritization, that's not coincidence, that's a pattern. It suggests the big buyers are positioning for a future where available silver and existing silver are not the same thing. Because silver sitting in a vault in one country protected by export restrictions is functionally unavailable to industries in other countries, no matter how much they're willing to pay. Let me make the scale of this physical. A monster box of silver coins, the standard bulk packaging, weighs about 70 pounds and contains 500 ounces. To visualize 100 million ounces, you're talking about 200,000 monster boxes. Imagine trying to transport, secure, warehouse, and manage 200,000 monster boxes of silver. The logistics alone are staggering. You need specialized vehicles. You need armed security. You need climate-controlled warehousing. You need inventory management systems. You need insurance. Nobody undertakes that kind of operation casually. This is strategic planning at the highest level. And this brings us to the question that makes some people uncomfortable but needs to be asked directly. Is a government involved? I'm not claiming I have proof of which specific government. I'm saying the behavior matches exactly what you'd expect if a major government was quietly building or replenishing a strategic stockpile of silver. And before someone objects with, why would they do it through the futures market instead of directly from miners? Standing for delivery on a futures exchange is completely legal. It's how the system is designed to work. If you have the capital and you follow the rules, you can demand physical delivery of as much metal as you want. And if you're a government agency or a state-connected institution, you might actually prefer to acquire metal through apparently normal market mechanisms rather than through direct government-to-government deals that would attract attention and potentially move prices against you before you've finished accumulating. The beauty of the futures market from a large buyer's perspective is that you can build a massive position over time through seemingly ordinary market activity, and then when you stand for delivery, the market has to give you the metal. But governments aren't the only potential explanation. We also need to talk about industrial giants, because the industrial demand side of silver is not theoretical. It's very real and it's accelerating. When a company that depends on silver for manufacturing starts securing supply directly from mining companies, bypassing the open market entirely, it's not because they want to speculate on price. It's because they fear supply disruption. They're terrified of the scenario where they need 10 million ounces for next quarter's production run, and they can't get it at any price because global supply has been locked up by other buyers. We've already seen the blueprint for how this works in other commodities. Major buyers go directly to miners. They buy doré, the impure alloy that comes straight out of the mine before refining. They buy concentrate. They lock down the feedstock at the source. They pay premiums. They sign long-term contracts. They sometimes even invest in or acquire mining operations to secure supply. They remove the middleman. They eliminate market risk. That is not the behavior of companies that believe silver will be plentiful forever. That's the behavior of companies that believe the next shortage could shut down their production lines and destroy their business. And here's where it gets truly volatile. When industrial buyers start to panic, they don't buy just what they need. They front run, they overorder, they stockpile. They say to themselves, if I'm going to need this for the next 5 years and I'm not confident it will be available, I'd rather hold too much than too little. Because running out of silver isn't like running out of office supplies. For an electronics manufacturer, for a solar panel producer, for a defense contractor, running out of silver means production lines stop. Contracts can't be fulfilled. Customers go to competitors, share prices tank, executives lose their jobs. So you've got this perfect setup for a supply squeeze. On one side, you have industrial demand that's non-negotiable. These companies literally cannot function without silver. On another side, you have investors who see silver repricing and want exposure for their portfolios. On a third side, you have governments that view silver as strategic and want supply security for national interests. And on the fourth side, you have retail investors who show up last, pay the highest premiums, and fight for scraps. That's not me being dramatic. That's how commodity cycles always work. The smart money secures supply early. The dumb money chases prices after the move is already over. And if you want one simple fact that tells you silver is not a normal commodity, here it is. A surprisingly small percentage of mined silver comes from primary silver mines. The vast majority comes as a byproduct of mining other metals: copper, lead, zinc, gold. Why does this matter? Because byproduct supply doesn't respond quickly to higher silver prices. If silver doubles in price, copper mining companies don't suddenly double their copper production just to get more byproduct silver. The supply response is sluggish. The supply curve is inelastic, so when demand rises sharply and supply can barely respond, the pressure doesn't release gradually through small price increases. It builds and builds until something breaks, and then price doesn't go up 20%, it goes up 200%. That's how inelastic markets behave. That's how supply squeezes work. And every piece of evidence we're seeing suggests we're in the early stages of exactly that kind of squeeze. Now let me address what I know some of you are thinking, but silver has moved so much already, it went from $30 to over $90. Isn't this a bubble? Isn't it time to sell and take profits? Here's the crucial distinction you need to understand. There's a difference between a bubble and a repricing event. A bubble is driven purely by speculation and emotion. It inflates when people believe, and it collapses when belief evaporates. Remember the dot-com bubble? Companies with no revenue and no business model traded at billion-dollar valuations because people believed in a story. When belief broke, the bubble popped, and 90% of those companies went to zero. A repricing event is completely different. A repricing happens when the underlying fundamental reality changes, and the old price no longer reflects the new supply-demand structure. When you have multi-year structural deficits, meaning the world uses more silver than it mines every single year, that's not speculation, that's math. When you have buyers physically removing millions of ounces from the market, that's not emotion, that's behavior. When you have governments declaring silver a critical material and implementing policies to secure domestic supply, that's not a trend. That's structural change. This is a scarcity narrative, not a bubble narrative. And scarcity narratives have a nasty habit of becoming very real very fast, usually at the exact moment when conventional wisdom says they're impossible. Let me talk about something that most small investors completely miss. The difference between price action and ownership behavior. Price is the public scoreboard. It's what you see on charts, it's what financial media reports, it's what creates fear and greed in retail traders. But ownership behavior, who's buying, who's selling, who's taking physical delivery, who's securing supply chains, that's the private strategy. That's what the smart money does when they don't want you to know what they're doing. And right now, ownership behavior is screaming. If the largest, most informed, most sophisticated buyers in the world are moving billions of dollars into physical silver acquisition month after month after month, you have to ask yourself, what do they know that you don't? Do they know about future industrial demand that hasn't been announced yet? Do they know about supply disruptions that haven't been made public? Do they know about policy changes that are being discussed in closed-door meetings? Do they know about hidden short exposure in the banking system that will have to be covered? Do they know that the paper silver market is far more fragile than retail investors assume? Or maybe, and this is the simplest explanation, they know that in a world where every major currency is being devalued through money printing, hard assets are the only real wealth preservation. That might sound simplistic, but it's probably the most important factor of all. Which brings us to the part of this story that connects silver to everything else. The dollar. People love to say the dollar is strong. They point to the dollar index, the DXY, and say, look, the dollar is at multi-year highs. The dollar is sound. But that's one of the most dangerous optical illusions in modern finance. The dollar index measures the dollar against other fiat currencies. The euro, the yen, the pound, the Canadian dollar. It's measuring the dollar against other pieces of paper that are also being printed into oblivion. It's like saying you're the healthiest patient in the cancer ward. A much more honest measurement is, what can your dollars actually buy? And when you measure dollars against real assets, gold, silver, land, energy, food, the picture is dramatically different. Let me give you a simple example that illustrates this perfectly. 20 years ago, the average U.S. house price was around $200,000. Gold was trading at about $400 per ounce, so it took roughly 500 ounces of gold to buy an average house. Fast forward to today. The average house price is over $400,000, but gold is over $4,000 per ounce. When you do the math, it now takes only about 100 ounces of gold to buy that same house. Think about what that means. Measured in dollars, the house went up 100%, but measured in gold, the house went down 80%. Which one changed, the house or the currency? The house didn't change, the currency changed, the unit of measurement melted, and this is the part most people psychologically cannot accept. The currency is the thing that's moving, the dollar is the variable. Real assets, houses, gold, silver, land, commodities, those are relatively stable. It's the paper money that's inflating, deflating, and losing purchasing power. So when someone says silver is going up, a more accurate framing would be the dollar is going down and silver is revealing the truth. Silver isn't becoming more valuable in some absolute sense. It's maintaining its value while the currency loses value. And that matters enormously because if the system is built on perpetual currency dilution, and it is, that's not even controversial anymore, that's official policy, then hard assets don't need to win. They just need to remain hard while money remains soft. So what does all of this mean for you? If you're a small silver investor, you need to understand your limitations and your advantages. Your limitations. You can't outbid governments. You can't outmuscle industrial giants who need silver to operate. You can't outleverage hedge funds with access to cheap credit. But your advantages are real. You can pay attention early. You can understand the difference between paper narratives and physical signals. You can stop letting mainstream financial media scare you out of positions at exactly the moments when smart money is accumulating. You can think like a risk manager instead of a gambler. And most importantly, you can avoid the trap that kills most retail investors, waiting for confirmation from the same outlets that ignored all the signals. Because here's the brutal truth. Once mainstream media starts screaming about silver, once it's on the cover of magazines, once your relatives are asking you about it at family dinners, it won't be because it's safe to buy. It will be because it's already obvious. And when an investment becomes obvious to everyone, it's usually expensive and often near a top. The opportunity exists right now in January 2026, precisely because most people still don't understand what's happening. The delivery data is public. The policy shifts are documented. The supply deficits are acknowledged even by industry groups. But it hasn't clicked for the masses yet. That's your window. Let me give you some practical guidance because I'm not here to just scare you or excite you. I'm here to help you think clearly. If you're holding physical silver right now, don't let short-term volatility shake you out. Understand that violent price swings are normal in a repricing event. If silver drops 10% next week, that doesn't invalidate the thesis. It's probably just weak hands getting flushed out or short-term speculators taking profits. The underlying structural drivers, supply deficits, industrial demand, critical material status, delivery pressure, those don't change because of a price dip. If you're looking to add to your position, consider building over time rather than trying to time a perfect entry. Dollar cost averaging isn't sexy, but it works. Buy some now. Buy more on dips. Keep some dry powder in case you get a gift. A flash crash that gives you an entry you never expected, because in volatile markets, opportunities come fast and they disappear fast. And most importantly, educate yourself on the signals that actually matter. Stop watching daily price charts like they're going to tell you something meaningful. Start watching delivery data. Watch whether these elevated delivery numbers continue or fade. Watch physical premiums. If you see premiums on physical silver coins and bars start spiking well above spot price, that's a signal that physical supply is tightening. Watch whether industrial companies announce supply partnerships or acquisitions of mining assets. Watch whether more governments announce silver stockpiling programs or export restrictions. Those are the signals that precede major moves. Let me tell you what I'm watching specifically in the coming weeks. First, we're still early in this delivery window. There's time left in the cycle for more contracts to stand for delivery. Historically, after a big initial rush of delivery requests, things cool off. People who wanted metal got it, the market relaxes. But if this pace stays elevated instead of fading, that tells you this isn't a one-off event. That tells you this is a sustained campaign of accumulation by one or more very large players. Second, I'm watching how quickly the exchange's deliverable inventory gets replenished after large deliveries. If inventory gets restocked immediately and easily, that means the system is comfortable. There's plenty of metal waiting in the wings. But if inventory replenishes slowly, or if you start seeing unusual movements between different inventory categories, that suggests the system is under stress and struggling to source metal. Third, and this is the big one, I'm watching for any signs of unusual incentives being offered to cash settle contracts instead of taking delivery. If you start hearing about premium payments being offered to people who will close out their contracts for cash instead of demanding metal, that's the exchange essentially admitting, we'd really prefer you didn't take delivery right now. That would be a massive red flag that physical supply is genuinely tight. And fourth, I'm watching what happens as we approach the next major delivery month. Big players often position early. If they were willing to pull this much metal in minor months, imagine what happens when March or May rolls around and the calendar gives them the bigger delivery window. If we see similar or larger delivery numbers in major months, that could be the catalyst that breaks something in the paper market structure. Here's my final thought, and I want you to really absorb this. Silver is not a get-rich-quick lottery ticket. Silver is a strategic asset that sits at a unique intersection of multiple massive trends. It's simultaneously a monetary metal with thousands of years of history as money, an industrial commodity that's essential for modern technology, and increasingly a strategic material that governments want to control. That combination is extraordinarily rare. Most commodities are purely industrial. Some assets are purely monetary. Silver is both, and that duality creates dynamics that most analysts don't understand.